And we are gonna get started and start diving into actual trading, looking at charts. What is Forex? What is this whole shark strategy that everybody's been talking about? We're gonna get down to the nitty gritty, the boring stuff behind the scenes, what's going on, and we're gonna teach you exactly what you need to know. No BS. We cut out all the nonsense and noise that you don't need, and we're just gonna be teaching you here exactly what you do need to be a profitable trader. Because here's the thing, is in this industry, there's a lot of information. Just go Google Forex, YouTube Forex. There's a lot of information out there, a lot, okay? That's dangerous if you want to be a profitable trader. It's really dangerous. It's because a lot of that information, in fact, probably 95, 98% of it isn't very helpful, is in fact going to do more harm to you than it is going to do good. And that comes down to the 98% rule, 95% rule, whatever you want. 2% of the population are really killing it, other 98% are average. Whatever statistic you want to use, that's what it comes down to. So you really got to be careful what you learn, because I'll tell you firsthand, my experience, I learned everything else first. I learned and even traded with every other strategy prior to this. It was a very expensive lesson for me. I learned a lot, but it also cost me a lot of money doing it. And so what I want to do for you is just teach you what does work and what doesn't work, and how to avoid making the mistakes that I made. All right, so let's jump right into it. Here real quick, a lot of my clients here, a lot of you guys are already traders and already understand what's going on, what is Forex and this stuff. And if that's the case for you in particular, just be patient. I encourage you to follow along anyway. If you're completely new, you're in for a treat here today. So what is Forex? Forex is foreign exchange. It's basically the exchange of currencies across the markets as their values fluctuate against other economies. So take an example here. Think of this as an example. You live in the USA, right? Let's say you live in Oregon. You're a hipster from Portland, okay? And you want to make a trip to Canada. For why? I don't know. I don't know why somebody did that. But so you travel to Canada, right? You have to exchange US dollars for Canadian dollars, and the exchange rate is not 1-to-1. All right. It's never going to be 1-to-1. All right, and that difference in the value is where we make our money, because those exchange rates change all the time. And in Forex, we trade currencies in pairs. They're quoted against each other. It's called with a base pair and a quote pair. All right, and they're quoted against each other. So the fluctuation in these exchange rates and the values is where we make our money. All right, but we do it on a larger scale within the financial markets from our computers and smartphones, rather than constantly having to, let's go to Canada, exchange our money, and then live there for a few months until the exchange rate is the opposite, and then we go back to America and then exchange it back. And then you see what I mean? That's just an example. Probably not very accurate, but that's an example. You see what I mean by that. So instead of doing that and waiting months and months, we do it on the financial markets, much larger scale, and it's much quicker. And we can do it. The beauty of this is I trade primarily now these days from my smartphone. I just have an iPhone, and that's what I trade from on a day-to-day basis from wherever I am. If I'm out getting groceries and I get an alert from I have my computer set up to text me when certain things happen on a chart. If I get that alert, I jump on my MT4 app that I have on my phone. If I like the setup, I take it. It's literally that easy now. I don't mark my charts. I know a lot of people do that. I don't mark charts at all. I hate doing that. I came into this industry. Yes, I like trading. Yes, I like the Wall Street lifestyle. But honestly, what are we here for? We're here for money. We're here for the freedom to do what we want with our life, for the options, right? So if I can make it even more simple than sitting on a computer for a couple hours a day, if I can even alleviate that to where I'm just on my phone periodically, yeah, of course I'm going to do it. Of course. So let's jump into it. Sorry for drawing it out a little bit. I want to make this a really jam-packed turbo course for Forex. So we're going to go ahead and move on. So what we need to know a little bit of fundamentals is what they call it. Let me tell you real quick. There's two different kind of traders out there. They're classified as fundamental traders and technical traders. Fundamental traders trade off of economic data, news releases, all of the employment rates, all of that, interest rates, treasury bonds, all of that stuff that's what fundamentals traders use to trade. And I think that's just way too much to learn. You don't need to actually be a good fundamental trader. And here's the thing, you don't need to learn all that. It's much easier to learn the strategy that we're going to teach you. You can learn it in a week and be profitable with it in a week. Being more of a technical trader. But here's the thing. Yeah, I would be classified as a technical trader. However, I do understand the fundamentals behind the markets, and I do pay attention to them at certain times throughout my trading. Okay? So yes, we're technical traders. However, we understand fundamentals. Okay? Now, what moves these markets? These markets are affected by many factors such as economic data releases, employment rates, natural, unnatural disasters. Major banks and financial institutions, we call them market makers. They're actually out there trading against you. Okay, they manipulate the markets on a small scale sometimes, most of the time. But yeah, it's absolutely, they're trading against you. They're trying to take your money. Absolutely. So that's what's going on back there. Some traders claim that these markets are too big to be manipulated, and that's wrong. Banks and institutions will absolutely move against you because that's how they make their money. But this can be accurately spotted and predicted with the proper training. Okay, and that's what we're going to teach you here today. You can spot when because they're not totally random. If you look at this chart if you look at a currency chart, to the untrained eye, it might look like chaos. It might look totally no rhythm to it, no rhyme or reason, just utter chaos. But let me tell you, it's not. All right, there's a rhyme and reason to every move. All right, they happen at certain times of the day. You can predict moves. Certain times of the week, you can predict moves. Just because we understand what the banks and financial institutions are doing on the other side of the playing field. So, and we'll get into that a little bit. Let's go ahead and move forward. So we need to talk about the spread, all of the nitty gritty stuff that, all as part of trading. And the spread is actually a big factor in our trading is because we are, I guess we'd be classified as scalpers. We take the market for a small amount of pips, price interest point, and we'll get into that in a minute. We trim the extremes or the tips of the market. They call us scalpers. So the spread is an important factor because to us, kind of every pip counts. So what the spread is the difference between the bid and ask price of a currency pair. Now, this will vary at different times of the day and with different brokers. The lower the spread, the better. Okay? So what we have here is an example. Let me see if I can get a little. Oh, I can. How about that? All right, so what we have here is an example. So I just wrote this up. The euro against the U.S. dollar is actually a currency pair. It's a very liquid currency pair. And so I'm using this as an example. That's the most well-known one, currency pair. So what this would be, we got the euro on the left. This is going to be our base pair, right? Also known as the bid price, and then on the right, we have the U.S. dollar. We have the quote pair or the ask price, right? So this isn't accurate. This is, these numbers aren't accurate. This is an example, okay? So don't go look at a chart and look for this exact number. I just wrote this up as an example. So in most currency pairs, the fourth decimal is a pip, or is 1 pip. And a pip, if you look down here, is a price interest point, okay? That's a recording of an increase or decrease in value, okay? So what we have here, the fourth decimal, right? We have a 0 and a 2. We have a difference of 2. The spread is 2 pips, okay? Just like that. Now, so if the EUR USD, which is the currency code for the euro against the dollar, US dollar, is at 1.1200, that means at that time that €1 equals $1.12. Okay, that's kind of how you can read that, right? Don't pay too much attention to these numbers. It's just an example. Honestly, I really don't even count pips anymore. I can just, I've been looking at charts and executing trades successfully for so long that I can just understand and kind of just spot offhand where my targets should be. I really don't pay attention anymore, but it's important for you to know, especially if you're a new trader. If you're absolutely like no experience, you need to understand what all these numbers mean, right? Where's the money coming from? What does this mean? So it's very important. So in most pairs, it is the fourth decimal is a pip. So pips are represented as the fourth decimal of a currency price except for yen pairs, where it's the second decimal. So I personally trade only one pair, and that's GBP JPY. That's a Great British Pound against the Japanese yen. So that's a yen pair, whereas that would be a second decimal pip, right? I don't know why they're weird like that, but they are. Okay, so that's the only pairs that differ from that. Okay, so we look for 1.5 pips spread or less. That's 15 point. On your trading terminals, it'll often be recorded in points. It'll say 15 points. That's 1.5 pips. It's in tenths. Okay, so 10 points is 1 pip. Okay, and again, a pip is a price interest point. That's a recording of value and as it changes. So let me get my cursor back here and let's move on. All right, so if you open up your terminal, which you should have done in the last tutorial, you can check out the currency pairs and the prices they're trading at that time. So as we see here, this is a screenshot from one of my trading terminals. We're just checking out some currency pairs, the spread, and the prices. So let's look at the euro dollar here for a second. We have EUR USD. The bid 1.13343, so we're right there. You see that fourth decimal, 4. It's at a 4. Pipette is what they call it. I really don't even, I just disregard it. Pipettes, nobody counts those. If you want to count those, you can. But anyways, a pipette in most pairs, this for example, except yen pairs, would be the 5th. So that would be this third or 5th decimal, which is this 3 right here. So and then we look over here. The ask price is the exact same. So this is a highly liquid pair. This was from one of my favorite brokers, very low spreads. So the spread was 0. That's phenomenal. It's really good. Okay. The lower the spread, the better. All right. So we're going to go ahead and move on. If you need to review that, just pause it, rewind, or just look at your own terminal. And usually these numbers, when the markets are open, are always flashing red and blue as they're changing. It's just always live. So yeah. Now, what we use candlestick charts for our trading and analysis. That's how we look at price. That's how we look at history, past price data, where it's been in the past. That's what we do all our analysis on is candlestick charts. I don't use bar charts. They are obnoxious. Never even use. You should not even look at them. I don't use line charts really either because I feel like you get a lot more accurate data from candlesticks. So that's what we use. Okay, so we use candlestick charts, and let me just tell you. Let me break down a candlestick for you here. Let me get a little highlighter again. So what we have here is we have a candlestick. Okay, we have we call this this part up here. It looks like a tail. We call that a wick, and there one on the top and one on the bottom. Okay. Now this solid part, that's the candle body. Okay. Now wick to wick is the range of the price movement for that candle's time frame. So if we're looking at a 5-minute chart, each candle from open to close is going to take 5 minutes. So what that means is that the price moved from here all the way to here within that 5 minutes before closing. However, it opened here and closed here. Take a look down here. The body of the candle is the open price price and close price for that candle's time frame. So at the beginning of that 5 minutes, this one opened, well, actually it's a bearish candle in this example, so it moved further down, and we'll get into that in a minute. It opened here, although it traveled here, but it opened here, traveled down here, but it closed here, right? This one a bullish, opened here, traveled all this direction, but closed here. The body of the candle is the open price and close price of the candle's time frame. The wick is the total range that it moved during that time. Now, if price closes higher than it opens, the candle is bullish. It's an up. Bullish would be uptrend over a period of time, okay? It's going up. If the price closes lower than it opens, the candle's bearish, right? Down, okay? Candles with long wicks to one direction are often a sign of reversal. Now, if we check this out, you'll see a lot of formations like this. All right. So if we didn't see these green candles right here, we just saw these long wicks down in here. It kind of stabilized. Call this a little hammer formation. This would be pretty solid indication of a reversal just based on price action. Obviously, we were more so technical traders. We would take a look at our TDI and see what's going on, and as well as the Bollinger Bands on the chart. But this alone, pretty good indication. So we definitely look at the wicks, see what's going on, and we take very close consideration of the spread during that time. So let's go ahead and move on a little bit. Now, how do certain times of the day affect the markets? Market conditions will vary at different times of day, or we call it during different trading sessions. We separate the trading day into 3 sessions: Tokyo, London, and New York. The market opens in Tokyo, ends New York. There's a small gap, and then it opens again in Tokyo 5 days a week. We trade, let me get that little highlighter. We trade London and New York. Now, volatility and liquidity is the most ideal during the London and New York sessions. The spreads are the lowest, and you'll typically see the most movement in the markets during these times. Okay, Tokyo session is very slow. It's very choppy usually, and the spreads are usually higher. Okay, it's not a prime session to trade. Are there good setups there sometimes? Absolutely. But if you're looking for the prime hours, it's these 2 sessions, London and New York. Okay, so what I do, what you should do, being a full-time trader, is you should start trading coming out of the Tokyo session, so the back end of the Tokyo session, going into the London session. And you should stop trading coming out of the New York session and back into the Tokyo session, okay? So that little period back into this, you'd start and you'd close, you'd stop back into this, right? Okay, those are the ideal sessions. Now, if you want to know the exact hours for that, Google it. Look, I don't know what time zone you're in. Just Google it for your time zone. See what it is. Map it out. Set alarms on your phone, whatever you need to do, and figure out what your prime hours for your time zone are. Okay? All right, let's move on. Now, let's take a look how price reacts at session changeovers. Often you will see reversals at the session changeovers, as these are used by market makers and institutions for trap moves. Okay, they're little fake moves to try to, mess up your trades. So what we see here is a choppy Tokyo session, which is pretty typical. You see how narrow the range is. These bands are pretty squeezed up right here. Really choppy market, just tightly consolidating. That's a pretty typical Tokyo session, Asian session, whatever you want to call it. Now we coming into the changeover to London session, starting to see a little bit of movement, have another tight squeeze here, and then we're gonna reverse to New York. Now that's pretty typical. You see a fake out in London, it'll reverse and then it'll follow that trend to New York, and then it'll counter and end the day pretty much where it started. Okay, so now what do we see here? This is all London session, and then we're changing over into New York up in here. Remember what I just said? We see all these wicks facing up right here. New York session, what do? We basically backtracked and went back to where we were. Where did we end up before the day ended? Pretty much where we started. Pretty typical day. Now, end of New York session, going into Tokyo session, market starts to chop and slow down. Okay? You see how it's just starting to slow down and chop up a little bit, really squeezing into here. Tight consolidation, high spreads through the Tokyo session. So again, start trading coming out of the Tokyo session into the London session. Stop trading coming out of the New York session into the Tokyo session. Okay, those are prime trading hours. Now, lesson review. This was a quick one, and we're going to get into exactly how we use those indicators and stuff that was on my chart here in the next lesson. Now, if we're going to look back on this lesson here in brief detail, Forex is the trading of different countries' currencies as their values fluctuate against each other. Now, what we use for this is we use MT4 as a trading terminal, and we go through whatever broker fits our trading style. For me, I have mine listed on the site because that's it. That's what I use. So you get registered with a broker, you sign up, you fund an account, you download MT4, and then you start trading. Okay? We use candlestick charts to map and analyze price movements because I feel like they're the most accurate and they give us the most data about what price is actually doing. We start trading coming out of the Tokyo session and stop trading coming out of the New York session. Session changeovers often cause a price reversal and can be capitalized on now that you know that and when they happen. Okay? Now, we're going to wrap this one up, and then we're going to, in the next lesson, jump into the official shark strategy and how we use all of this information combined with some more information to make all this crazy money you guys have been seeing about and how you can do the exact same thing going into, at the end of this week or into next week. That's how simple it is. So I'll see you for the next lesson.